The housing collapse of 2025 is no longer just a dire prediction whispered by analysts. It's happening right now, unfolding in plain sight. Across the country, communities that only a few years ago were riding waves of prosperity are now sinking fast. Neighborhoods are flooded with listings that no one wants, price cuts are slashing deeper every week, and sellers are panicking as their supposed nest egg turns into a financial trap. In some of the hardest hit regions, home prices aren't just dipping, they're imploding, dropping by an astonishing 50 to 80%. For many families, the financial blow is even harsher than what they lived through back in 2008. Builders are scrambling to offload inventory, buyers have all but disappeared, and investors who once poured money into real estate are now rushing to sell before the entire system collapses around them. From the parched deserts of suburbia to once idyllic coastal communities, no market feels truly safe anymore. Equity that took years to build is evaporating almost overnight, and mortgage payments are crushing households, turning what was supposed to be the American dream into a nightmare of debt and stress. And at the center of this storm are 10 housing markets that stand out as ground zero. These cities aren't just struggling, they've become the epicenters of a nationwide housing disaster. The worst part? The suffering we're seeing today is only the beginning. Number 10. Denver, Colorado. Denver, the mile-high city, has long been celebrated for its stunning mountain backdrops, thriving outdoor lifestyle, and its rise as a tech hub that drew in remote workers and ambitious young professionals. That combination turned it into one of the most desirable housing markets in the country, with home prices skyrocketing more than 50% since 2020. But in 2025, Denver's real estate market is showing cracks that could quickly widen into something resembling the chaos of 2008. Analysts warn that if the broader economy stumbles, Denver could see home values tumble 15% to 20%. The city's meteoric rise was fueled by an influx of high-earning transplants, a red-hot tech industry, and a lifestyle that made it irresistible to newcomers. Yet the very forces that drove demand are also its biggest vulnerabilities. If tech hiring slows, or worse, if layoffs accelerate, demand dries up almost instantly, leaving sellers scrambling. The affordability problem is already severe. At today's 7% mortgage rates, many buyers are stretched to their financial breaking point, and Denver's housing market is dominated by people carrying dangerously high debt-to-income ratios. If job losses start hitting, thousands of households could find themselves unable to keep up with payments, flooding the market with listings, and we're already seeing early signs of that squeeze. Inventory in Denver has jumped nearly 40% year over year, and the average home now lingers on the market for around 75 days, far longer than during the peak years of frenzied bidding wars. If conditions worsen, this growing surplus of unsold homes will collide with shrinking demand, forcing painful price cuts and wiping out equity. For many homeowners, it could feel eerily familiar, another wave of financial devastation, echoing the crash they thought was long behind them. Number 9. Sacramento, California. Sacramento has long been marketed as the Bay Area's more affordable cousin, a city where families priced out of San Francisco or Silicon Valley could still chase the dream of homeownership. During the pandemic, that story turned into a stampede. Thousands of Bay Area residents fled east, and their flood of money pushed Sacramento's housing market into the stratosphere. Between 2020 and 2022, prices surged more than 40%, with the median home peaking near $540,000, but in 2025, the cracks are impossible to ignore. That same median price has slipped to roughly $450,000, a gut-punch 16.7% decline that wipes nearly $90,000 off the value of a typical home. For many recent buyers, that's not just a paper loss, it's the evaporation of their entire down payment. What makes this particularly concerning is how familiar the pattern feels. Sacramento was one of the hardest-hit cities during the 2008 housing crash, and the warning signs today look eerily similar. Back then, the problem was over-reliance on outside demand and overstretched affordability. Today, it's the same story. Mortgage rates hovering at 7% make homeownership nearly impossible for locals earning the area's median household income of about $75,000. The inventory situation only makes things worse. Listings are up a staggering 46% compared to last year, which means there are far more homes for sale than buyers ready, or able, to scoop them up. Price cuts have become the norm, and sellers who once held the upper hand are now chasing the market down. And here's the real danger. The Bay Area pipeline that once fueled Sacramento's growth has slowed to a trickle, while investors who rushed in during the boom are retreating just as fast. That leaves Sacramento vulnerable, teetering on the edge of another painful correction. For homeowners who bought at peak prices, the threat is clear. The equity they thought would build their future could vanish just as quickly as it did 15 years ago. Number 8. Tampa, Florida. Tampa used to be the star player of Florida's housing boom, a fast-growing city with jobs pouring in, shiny new development, and waves of new residents. In the early 2020s, it felt unstoppable. The city's rise wasn't just organic growth, it was also fueled by a tidal wave of money, remote workers relocating, retirees chasing the Florida lifestyle, and even big Wall Street-backed investors scooping up properties like poker chips. Between 2021 and 2022, that frenzy sent prices into orbit. The average home value shot up to about $383,410, a number completely detached from what most local paychecks could actually support. Bidding wars weren't the exception, they were the rule, and it was obvious that a bubble was forming. But fast forward to 2025, and the shine has worn off. Average prices have already slid down to around $360,130, and the real red flag is in the inventory. The number of homes for sale has exploded, up more than 55% year over year. Properties that once sold in less than 2 weeks are now collecting dust for 75 to 90 days on the market. That kind of slowdown is a clear sign that demand has evaporated. Another ticking time bomb? The short-term rental market. Thousands of Airbnb and vacation rental owners are dumping their properties back into the resale market, flooding supply even further. On top of that, today's 7.5% mortgage rate shave locked out a huge share of potential buyers, leaving homes priced for a demand pool that no longer exists. What once looked like Tampa's greatest strength, aggressive, fast-paced growth, has now become its Achilles heel. The city is staring at a dangerous cocktail of overvaluation, oversupply, and vanishing demand. If current conditions don't reverse, Tampa isn't just in for a slowdown. It's bracing for a serious correction that could wipe out wealth across the region. Number 7. Bakersfield, California. Bakersfield has never been about glitz and glamour. What made it appealing was something far simpler: affordability. For years, it stood as the relief valve for California's housing pressure cooker. When families were priced out of Los Angeles or suffocated by Bay Area costs, Bakersfield was the place they fled to. Wide open land, cheaper prices, and the promise of space, Bakersfield offered what the coastal cities no longer could. During the pandemic housing boom, that demand sent prices skyrocketing. In just 3 years, the typical home leapt from about $240,000 in 2019 to nearly $440,000 by 2022. For a city once known as sleepy, that was an earth-shattering surge. But fast forward to 2025, and Bakersfield is no longer a safe haven. It's a market in crisis. The biggest problem? Affordability. Bakersfield's one-time strength has collapsed. Local wages, rooted in industries like agriculture, energy, and logistics, simply didn't rise alongside those explosive housing costs. Families who could once comfortably buy in now faced payments they can't possibly sustain. With mortgage rates stuck near 7%, the median home now comes with a monthly bill of over $3,200. For most Bakersfield households, that's not just high, it's impossible. Adding fuel to the fire was the investor frenzy. At the peak, nearly 1 in 4 homes was snapped up by flippers or outside investors betting on endless appreciation. That gamble has backfired spectacularly. Many of those same homes are now hitting the market again, this time with steep price cuts of $50,000 to $100,000. Just so investors can escape before the losses get worse, and the storm clouds are only thickening. Inventory keeps climbing, wages are stuck in place, and demand from out-of-towners has cooled dramatically. If those trends continue, Bakersfield isn't just looking at a slowdown, it could see home values plunge as much as 60%. Effectively wiping out all the gains of the past 5 years and dragging the market back to pre-2020 levels. That wouldn't be a correction. That would be a full-on, second housing crash, one even harsher than the first. Number 6. Dallas, Texas. Dallas, the shining star of North Texas. For years, it stood as the poster child of endless growth, with skyscrapers rising, corporations flocking in, and suburban sprawl stretching as far as the eye could see. Companies relocated here by the dozens, tech jobs poured in, and people came chasing the dream of opportunity. And with that flood of people came a housing boom that inflated faster than almost anywhere else in the country. Between 2020 and 2022, Dallas home prices didn't just climb, they exploded, often surging 60% to 80% in just a few short years. Entire suburbs in Collin and Denton counties were transformed almost overnight with endless new construction. At the time, it all felt unstoppable, a city on fire with growth. But here in 2025, that fire looks more like a ticking time bomb. The warning signs are impossible to ignore. Inventory is piling up at a frightening pace, up 45% year over year. Homes that once sold in a weekend now sit for an average of 75 days, collecting dust as sellers slash asking prices to lure in hesitant buyers. And it's not just ordinary homeowners. Investors who piled in during the boom are now racing for the exits, dumping properties onto an already crowded market and driving prices lower. The real danger for Dallas isn't just today's slowdown. It's what happens if the job engine that fueled this entire boom sputters. A recession or even a pause in corporate expansions would hit Dallas where it hurts most: its tech, financial services, and white-collar relocation pipeline. Without that steady stream of high earners moving in, demand evaporates almost instantly. And here's the bigger picture. Dallas isn't a small city where a correction can stay contained. It's a massive metroplex. That means when the bubble here deflates, the ripple effects spread across dozens of suburbs and millions of people. What was once marketed as the land of endless opportunity is now shaping up to be ground zero for Texas's housing bust. Number 5. Sedona, Arizona. Sedona has always been a place of mystique. A desert mountain town where breathtaking red rock cliffs meet spiritual retreats and an art scene that draws people from across the globe. For years, it wasn't just a destination, it was a lifestyle, a sanctuary for the wealthy, retirees, and dreamers who wanted something more than a standard suburban address. That demand turned Sedona's housing market into one of the hottest in the country, with median home prices shooting toward $850,000 at their peak. But by 2025, the story has flipped. Sedona's once unstoppable boom has cooled into a sobering reality, a luxury bubble that's rapidly deflating. The same exclusivity that drove buyers in droves has now left the market vulnerable to economic shifts. With interest rates stubbornly clinging around 7% and the national economy tightening, those high net worth buyers who once saw Sedona as the perfect second home getaway are suddenly pulling back. Discretionary spending on vacation properties is no longer a priority, and Sedona is paying the price. The data tells the tale. Inventory is up more than 35% in just a year, and homes that once flew off the market now linger for over 100 days. Multi-million-dollar listings are facing steep reductions, as sellers slash asking prices in a bid to attract the few buyers still circling. Investors, especially those banking on short-term rentals, are bailing out after watching profit margins disappear under the weight of new regulations, dwindling tourism demand, and rising maintenance costs. Add in Sedona's uniquely high expenses, steep WA dues in gated communities, insurance premiums climbing due to wildfire risks, and the generally elevated cost of living, and suddenly, owning here looks more like a liability than a luxury. For many, Sedona was supposed to be the ultimate retreat, a serene escape from chaos. But in 2025, the dream is morphing into something else entirely. Rows of overpriced homes sitting empty, a market caught between its past allure and its present fragility. The charm remains in the red rocks, but the housing market? It's drifting toward a desert mirage. Number 4. Las Vegas, Nevada. Las Vegas has always been a city built on high stakes, but this time, the gamble is going against the house. After one of the wildest real estate booms in the nation, the market here is now unraveling at a pace that feels eerily familiar to those who remember the collapse of 2008. Between 2020 and early 2022, the median home price in Vegas skyrocketed from about $290,000 to over $460,000. A jaw-dropping 58% jump fueled not by fundamentals, but by speculative buying, investor frenzy, and historically cheap mortgages. It was a perfect storm of hype and easy money. But in 2025, the deck has flipped, and what was once an unstoppable run has turned into a dramatic freefall. The warning lights are everywhere. Inventory has more than doubled in just a year, leaving the market flooded with unsold homes. Properties that would have sparked bidding wars just a couple of years ago are now sitting on the market for 3 to 4 months with little buyer interest. Even worse, nearly half of all active listings are discounted, often slashed by anywhere from $50,000 to $150,000 just to generate traffic. The root of the collapse lies in two forces: reckless overbuilding and rampant speculation. During the boom, developers raced to churn out new subdivisions, while out-of-state investors treated homes like poker chips, betting on endless appreciation. Now, that speculative crowd is cashing out, dumping properties back onto the market in a desperate rush to avoid even steeper losses. The short-term rental market, once a goldmine, has also turned sour. Airbnb income has dried up, rents are slipping, and properties once touted as cash flow machines are bleeding money. Layer on top of that the brutal math of today's mortgages. At over 7% interest rates, the same home that felt like a bargain in 2021 is now a crushing monthly expense. And here's the kicker: local wages never supported those inflated prices to begin with. Las Vegas is still heavily dependent on tourism and service industry jobs, sectors that haven't fully recovered to pre-pandemic strength. That makes this city especially vulnerable to a nationwide slowdown. If current conditions persist, experts warn that Vegas could see values slide all the way back to pre-2015 levels, which would mean a punishing 60% correction or worse. In other words, the so-called housing jackpot has turned out to be nothing more than another Vegas illusion, glittering under bright lights at first, but now evaporating under the harsh reality of rising rates, weak fundamentals, and an oversupply nobody wants to touch. Number 3. Boise, Idaho. Boise isn't just caught in a slowdown, it's becoming one of the epicenters of the 2025 housing collapse, a cautionary tale of how a pandemic-era boom can flip into a devastating bust almost overnight. From 2019 to 2022, Boise's market was on fire. The median home price doubled in just 3 years, jumping from around $285,000 to nearly $575,000. That's a jaw-dropping 100% surge, driven by remote workers, out-of-state buyers, and speculative investors who were convinced the city had endless room to grow. But here's the problem: what skyrockets that fast usually comes crashing down even harder. By 2025, those first warning signs had morphed into something far worse. Inventory has exploded, and homes that once sparked bidding wars now sit on the market for 140 to 150 days with little to no activity. Demand has dried up. The same newcomers who inflated the bubble are now underwater, watching their investments turn into financial traps. With rents slipping and mortgages climbing, the numbers simply don't work anymore. Investors who once bragged about their Boise properties are quietly fire-selling them at massive losses just to cut their exposure. For local families, the picture is equally grim. With mortgage rates hovering above 7%, buying a median-priced home now costs over $3,800 a month, completely detached from Boise's modest income base. That affordability squeeze has forced countless residents to the sidelines, widening the gap between asking prices and actual demand. The city's outskirts tell another part of the story. Entire subdivisions, built in the frenzy of the boom, now sit half-empty, ghostly reminders of just how reckless the overbuilding really was. Foreclosure filings are already starting to creep upward, an ominous echo of 2008. Experts warn the correction here could be brutal, with projections of up to a 60% collapse in home values, essentially dragging prices back to pre-2015 levels. For Boise, this isn't just a dip in the market, it's a full-blown reversal of fortune. What makes it so chilling is how closely it mirrors the last crash, but with even more dangerous conditions: higher debt loads, higher interest rates, and a population that stretched itself to the limit. Boise isn't just part of the downturn, it's becoming the frontline city leading America's housing crash. Number 2. Cape Coral, Florida. Cape Coral used to be sold as Florida's last affordable slice of waterfront paradise, a place where retirees, investors, and families could still live the dream. But in 2025, that dream has soured into a nightmare, leaving the city at the very heart of Florida's housing collapse. During the pandemic, the frenzy was unreal. The median home price doubled in just 2 years, jumping from around $230,000 in 2020 to over $470,000 by 2022. That meteoric rise was fueled by investors piling in, developers building at breakneck speed, and buyers desperate for a coastal bargain. But what goes up too fast almost always comes crashing down, and Cape Coral is learning that lesson the hard way. Today, the market is unraveling at terrifying speed. The region was massively overbuilt, and thousands of shiny new homes now sit unsold. Builders, once cocky, are in panic mode, offering $60,000 discounts, covering insurance premiums, even throwing in extras, but none of it is enough. Buyers have disappeared. One of the biggest culprits? Insurance costs. With flood risks climbing every year, premiums have more than doubled. Some homeowners are staring at annual bills of $9,000 or more just for coverage, effectively pricing middle-class families out of the market. Add in rising property taxes and ballooning WA fees, and suddenly Cape Coral isn't the affordable haven it once was. The result has been a mass exodus. Retirees who once flocked here for a peaceful retirement are packing up, and investors are cutting their losses before things get worse. Inventory has exploded, triple what it was in 2022, and over half of all listings have endured major price cuts. Homes that used to sell in weeks now languish for months as sellers slash their asking prices again and again. If these trends continue, analysts warn that Cape Coral could see home prices sink below $200,000, wiping out as much as 60% of property values. That would be one of the sharpest housing collapses in modern history, dragging countless homeowners underwater. Cape Coral once represented opportunity and security. Today, it feels more like a financial ticking time bomb, with the fuse burning dangerously close to its end. Number 1. Phoenix, Arizona. Phoenix isn't just dealing with a slowdown, it's rapidly becoming the epicenter of the 2025 housing crash, echoing its infamous role during the 2008 meltdown. The city that once symbolized boundless growth and opportunity is now at the front lines of America's unfolding real estate disaster. Between 2019 and 2022, the Phoenix housing market exploded. Prices leapt from roughly $280,000 to over $510,000, an 82% surge that was fueled by investors, remote workers, and corporate buyers scooping up properties at a reckless pace. But history has a cruel way of repeating itself. What skyrockets without solid fundamentals almost always collapses under its own weight. And that's exactly what we're seeing now. By 2025, the warning signs have turned into flashing red sirens. Inventory has quadrupled. More than half of all listings show price cuts, and many sellers are slashing over $100,000 just to attract a nibble of interest. Homes that once disappeared in heated bidding wars now sit stagnant for 3 to 4 months, and investors who once flooded the valley are stampeding for the exits. Phoenix's crash is especially brutal because it wasn't just driven by local demand. Institutional landlords and iBuyers bought thousands of homes, often sight unseen, betting on endless appreciation. Now, with rents falling and mortgage costs soaring past 7%, their math doesn't work anymore. Properties are being dumped at fire sale prices, wiping out entire neighborhoods of equity, and the locals? They're caught in the crossfire. With a median home carrying a monthly payment of over $3,800, ordinary families are priced out. Household incomes haven't kept pace, forcing many would-be buyers to give up altogether. Meanwhile, the outskirts, Buckeye, Queen Creek, Maricopa, are dotted with half-empty subdivisions. Builders are offering unheard-of incentives, from tens of thousands in credits to free upgrades, dragging comps down in the process. Even worse, foreclosures are climbing again. Buyers who stretched thin during the boom, especially those with low down payments or FHA loans, are starting to default. Analysts warn this is only the beginning of a deeper, systemic problem. If conditions persist, Phoenix could see home values collapse by 60%, erasing a decade of growth and returning prices to pre-2015 levels. This isn't just déjà vu, it's potentially worse than 2008. Back then, the damage was concentrated. Now, with higher debt, broader overvaluation, and more severe economic headwinds, Phoenix may become the cautionary tale of an entire generation. The truth is stark. The 2025 housing crash is no longer a forecast, it's here. Across the country, Once booming markets are suffocating under a tidal wave of listings, price cuts, and panicked sellers. From desert suburbs like Phoenix to coastal retreats in Florida, no region is insulated. Families are watching their hard-earned equity evaporate overnight, and monthly mortgage payments are grinding them into financial quicksand. The American dream of homeownership hasn't vanished, but it has been twisted into something far more dangerous. Builders are scrambling, buyers have vanished, and investors are liquidating before the floor gives way completely. So, what does this mean for you? If you're looking to buy in 2025, be cautious. Be strategic. Do your homework. Not every sunny promise is a paradise waiting to be claimed. Some markets are traps that won't recover for years, maybe even decades, and that's the key takeaway. Sometimes the smartest financial decision isn't knowing where to buy, but knowing where not to.